Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So recently I've been getting loads of different emails, loads of comments or private messages on the Patreon account and so on from brothers and sisters who are very much new to the stock market. They do have some money, they want to invest and they need some ideas. They've made up their mind they will definitely like to get into the stock market, but they just need some ideas. And of course I can't give financial advice, but I can give you some ideas, some of the things that I did, some of the researches that I've done, and just to kind of guide you hopefully to the right direction, and then you take it from there kind of thing. And that's the whole reason I started this whole channel. So I'm really happy when people ask me this type of questions. I'm now going through all the messages that I've received over the last few weeks, and then I'm going to look at the comment section on each videos and just to kind of see if there's any questions that I would like to answer. So if I have not answered your questions on the comment section, I apologize. InshaAllah, it is coming. It's been quite busy time, so InshaAllah I will get to that. And I genuinely appreciate your comments and everything else. And if you can like the videos, alhamdulillah, I genuinely appreciate that. And if you can join us the Patreon account where you get access to a lot of things, even you can private message me and so on. You get all the buys and sales, family portfolio, all the things that I normally mention. That will be genuinely helpful, and it will cost you only 15p per day. Join us, have a look at it, let me know what you think. Right, so in today's video we are looking at the difference between dollar cost averaging and lump sum. And we have so this is what this is in my head, this is how you should be looking at investment. Okay, now first of all you need to know what you invested in. So it's basically like whether you want to buy individual basically stocks or ETFs. And I did it recently, 2 videos for beginners, but this is for more or less for everyone. Okay, so this part 1 and part 2 will show you individual stocks as well as ETFs to start investing in if you are completely new, but also if you have started already but you're looking for new ideas. So watch these 2 videos first. The other thing I want to say is, so once you've done that, the next step is to understand, okay, how much should I actually put into this, basically whatever. And that's the bit we're going to talk about today. And the questions that I've got recently was, I've got £10,000 or so and so, should I buy this or should I buy this, or should I invest in all in one stock or different stocks or all in one go, or should I dollar cost average? So that's the bit that I want to tackle today. Next video we're going to talk about time horizon. So if you then 20 years old, what type of stock should you buy in? If you should be buying, if you are 30, what would you be doing? 40, 50, 60. So that's the kind of thing we will do. So this is more or less 3 parts. The first part is go and watch these videos until understand the investments that are available to us. And today we're going to talk about dollar cost averaging and basically lump sum. And the reason I like to basically look at this is because it is quite difficult to time the market. Because right now, someone might say to you right now, oh, the stock market is too expensive right now. Because a year to date, the S&P 500 basically is up 18%. So I'm just going to sit on the side and I'm not going to invest. And I think that's really the wrong mentality, of course. Okay, I'd rather you dollar cost average every single month than actually sit on that sidelines, because that you're never gonna make money. That money that's sitting on your account will be eaten away by inflation and all sorts of things. So you really now need to think about, okay, why am I sitting on the sideline? Okay, why can I not just buy dollar cost average every single month if I feel that comfortable, if I think it's too expensive, or maybe just keep some cash but be invested regardless. Buy a couple of ETFs and leave it alone. You know what I mean? So that probably will be better than, of course, just being on the sideline. And I've got one of my close friends who's actually got quite a bit of money right now, alhamdulillah, is right now saying, no, I'm not getting in. It's too expensive right now. And I keep saying to him, you know what, in the long run, you're going to regret doing this, because right now you're better off investing and just leaving it alone. So let's talk about today lump sum and dollar cost averaging. Okay, I'm going to explain what the terms mean, and I'm going to show you some of the research which has actually performed better. So they did a research a while ago. I think they were invested like £10,000 or dollars, whatever, into the market, and they kind of backtracked. So meaning they looked basically how the markets performed the last 30 years, and if you had invested basically £10,000 30 years ago, what would the which one would win basically, and I'll show you that research in a second. Okay, so let's talk about first what are these things. So first one is lump sum investing. This is where you actually say you've sold a house, you've sold a car, you made nice money, you've got 10,000, 20,000 pounds. You take that 20,000 pounds and you put it into the market. That's it. You buy, I don't know, 3 different ETFs, you diversify your ETFs and so on, and you basically invest every single penny of that 20,000 pounds. Done. Dollar cost averaging is different. Dollar cost averaging, you might want to say, okay, I've got 20,000 pounds to invest, but what I'm going to do is I'm going to add, I don't know, 1,000 every single month for however long. This month I might add 1,000, next month I might add 2,000. Okay, so you drip feed in instead of just putting all your money in the market in just one go. And that's the major difference between the two. And you might be thinking, why is this, why are we talking about this? Okay, let me just show you the benefits for each, and then we'll basically wrap up the video. Okay, so first of all, for lump sum, the potential for higher returns if the market goes up is one of the pros. What I mean by that is if you put 20,000 pounds right now and the market go up straight away and they keep going up, then of course you're going to make some good money, right? And then it's simpler to manage. You're not worried about time in the market. You just buy in one go. You've forgotten about it. So I've got a friend who actually buys every ISA time. He basically puts whatever he's got. So normally he targets for about 20,000, but sometimes lately it hasn't been 20,000, slightly smaller. But at the beginning of his ISA account, he'll put the money, 20,000, 10,000, whatever he's got, and then that's it. Leave it alone. And then next year comes, so he will save, and then next year comes, exactly do the same thing. Okay, because he says, you know what, I don't have the time. I'm not worried about. I know I don't need the money right now. I don't need to watch the market. What is happening day in, day out. I know what I want. I'm gonna buy it. I'm gonna leave it alone. And majority of the stuff that he's got stocks, but he's got also some ETFs. Okay. The cons of that is high risk if the market drops straight away. So if you put 20,000 pounds today or 10,000 pounds and the market go down 3, 4, 5, 6% and keep going down, of course all that money will be lost. But of course, again, it's a paper loss until you sell it, so you don't have to worry about it. If you are a long-term investor, then that shouldn't be a problem, right? Because in the long run, the markets will go up again and you wouldn't have to worry about it. So, but it requires also a large sum of money up front. And that's the only other thing. Not many people have, 20,000 pounds or 10,000 pounds lying around every single year. Okay, so for that reason, it's basically some of the risks or some of the cons of you doing this. Now, when it comes to dollar cost averaging, it's more or less the same. Okay, we talked about earlier, reduces the impact of market volatility. When I say I mean the opposite. Okay, so the opposite of what we just said. So instead of basically it reduces. Why? Because you're buying when it's down, you're buying when it's up. So market volatility is not like it's not like you're putting 20,000 and it goes down. Okay, what you're doing is you're putting 10,000 over a period of 13, 14, 15 months, and easier to budget, especially if you are still working, you don't have a lot of cash lying around, and what you want to do is automate your cash as soon as you get paid to go to your brokerage account so you can buy some quality companies. And if you're doing that, it's easier to manage, it's easier to budget. So you might want to say, this month, you know what, I'm going to put 1,000. That's what I've been doing. So there's some months where I've been putting 3,000 pounds. There's some months where I've been doing, say, the last couple of months, for example, closer to 700, 800 because of whatever, right? And psychological comfort, you know you're going to buy when it's up, you're going to buy when it's down, you're not putting all your money in one go and so on. That kind of helps you psychologically, gives you a bit of a comfort because some of your money is still in your hands and kind of thing, right? But the cons are potential for low returns if the market goes up consistently. So if you bought today at, I don't know, whatever certain price, and then tomorrow it went up another 2%, and then next day it went up, and the next Monday. So if you're buying on the highs, then of course it will be potentially your returns might be slightly lower. And also it's much more time consuming because you need to basically keep an eye on what to buy, when to buy, and so on. So like, for example, for me, I need to check my portfolio and see what companies are undervalued at the moment and what companies that have not hit my target of allocation. And maybe if I said 5% of my entire portfolio, right now it's about 3% and it's undervalued, and then for that reason I might buy more of that. So that discipline and basically checking your portfolio and so on, it can be time consuming. Okay. And also, so what do we do then? What is the good option between the two? So now we've seen this. Okay, so ideal for investors. So the lump sum is ideal for investors with a large sum of money to invest, okay, who have a high risk tolerance and a long-term investment horizon. Now that is really important. If you got a bit of cash and you want to invest all in one go, and your mentality is long-term investment basically horizon, I don't really care what happens this year or next year, I will see this portfolio maybe in 20 years from now. Okay, you don't have to worry about it. Then that is really lump sum investing is good. And that brother I was talking about, that's his mentality. I don't need the money right now. I'm going to keep investing every single year as much as I can and leave it alone. He doesn't even check the portfolio. He doesn't even care. He's buying the things that he knows and cares, and that's it. Whereas dollar cost average is suitable for investors with a small amount to invest, like myself. Okay, I don't have 20,000 cash sitting right now in front of me just to invest it straight away. So what I'm doing is I'm taking cut basically basically a bit of my salary every single month and invest. That's all I'm doing. So I'm just being more conservative approach to the whole thing, inshallah. And then of course, I'm not trying to time the market. So when it goes up, I buy. When it goes down, if you know me, you know that I have been dollar cost averaging every single month, every single week, £250 or 1,000 a month. Sometimes I've been buying more, sometimes slightly lower, but on average about 1,000. That's my goal. That's my basically thing. Okay. Now let me just show you the research that they've done. You can find this is the title for that, and what they've done is basically they took $10,000 or whatever it was, they back tested for the last 30 years. So the charts use the data going back to over 30 years, and the 10,000 is basically what they invested in. Now lump sum is the blue, is the yellow, and the dollar cost average is actually the blue side here. And as you can see, these are the times. Okay, so 3 months, 6 months, 9 months, 12 months. But the short period of time, as you can see, lump sum is actually outperformed. Okay, and this is because they back testing. Remember that. Okay, so this was I think for 1999 to 2000 and 2020. So they back tested that period of time. And this is exactly what you would have got if you've done that for the first 3 months. You would be up over, we would have done better than dollar cost averaging. Same goes for 6 months, 9 months, and 12 months. Now this is the part that I was interested in. Okay, if you look at the strategy for all types of markets, dollar cost average for 6 months, lump sum for 6 months, falling market. So if the market is falling, so September of 2008 to 2009, so that period of time, okay, February 2009, you would have made 10,000 more if you've basically dollar cost averaged, because the markets were going down. As they were going down, you were buying more for cheaper prices. Okay, now rising markets, so 2009, the March of 2009 to August of 2009, this is exactly what happened. So if you were dollar cost averaging, you would have lost a little bit. So you would have actually 68,000, that 10,000 would have become 68,000 that period of time. So do you really have to think about what basically is suitable for you? And this is why I said to, one of the brothers that I spoke to, I said, you know what, there is not much of a difference. It all depends on your appetite, and like what we said, the advantage, the disadvantage. If you've got the money and you're a long-term investor and you don't really care what the fluctuation of the markets and so on, then then it's lump sum and just leave it alone. If you are relying to get money from basically your salary and so on, then dollar cost averaging strategies might work better for you. And that's what I've been doing from day one. You've seen me buy every single week, and what I try to do is basically use my ISA account by the end of the year. That's my target. So right now 3,600, I've got 16,400 almost pounds to add between now and April, whatever the 6th or whatever it is, right? And every single month I'm going to continue and I'm going to share that journey with you guys, inshallah. And I have been doing that and it's worked for me, alhamdulillah. Okay, but if I had 20,000 pounds right now, I probably would still do the same thing. I'll probably buy a little bit more aggressively, okay, than I have been doing the last few months, but I will still dollar cost average. I wouldn't put 20,000 pounds straight away in one go. I will dollar cost average, knowing that it worked for me previously, and inshallah potentially it will work for me in the long run. Okay, so I hope you're enjoying this type of content. If you are enjoying, check this out, these two videos first, watch this one again, the one that we just did, this video, and then the next one will be based on your time horizon. So if you are in your 20s, what should you be buying, what kind of companies, and I'm going to give you some ideas and so on. And then if you're in your 40s, if you're 60s, we'll do exactly the same. So hopefully then you have a full picture of what to buy, you know, how much you should invest when it comes to dollar cost average, you know, lump sum, and then based on your time horizon, what type of companies should you own, or what type of company, what type of ETF should you aim for. Hopefully that will help you guys. If that helps, please just join us in the Patreon account, like the video, subscribe to the channel. Over 50% of you guys that regularly watch the videos are not subscribed. Come on guys, wallahi, it will help massively. Why? Because it will reach more brothers and sisters who would potentially, you know, get into investment world. This is the only way we can get out of the rat rate. And inshallah, hopefully by paying zakat, by helping other brothers and sisters out there, of course, inshallah, basically Allah will bless our investments and so on, inshallah. Anyway, have a wonderful day. Assalamu Alaikum.